In the internet bubble, back in 2000, people were saying profits don't matter, only market share does. When that bubble burst, everybody realized that what a silly thing to say. The real estate bubble, housing prices only go up, they never go down. After that bubble burst, everybody realized what a silly thing to say that housing prices only go up. Well, the money bubble, it's a similar type of thing that everybody says, well, the dollar is money, but it's really not. It's only a money substitute circulating in place of money. And as this money bubble bursts, people are going to go back and truly understand what gold really is.
It's been 115 years since investors had an opportunity like this. The energy of the future. Now Elon Musk and Frank Giustra are betting big on the rise of this energy source that will change the world. We're talking about the oil of the 21st century. Learn more at crushthestreet.com/charge.
Hello everyone and welcome into crushthestreet.com. Today I'm in Texas and I'm recording a call with the famous James Turk, a precious metals expert, original founder of Gold Money and co-author of The Money Bubble with John Rubino, What to Do Before It Pops. James Turk, thanks for coming on the line with me today.
Yeah, it's great to be talking with you, Ken.
Well, we haven't seen that much action this month here in July with precious metals. And, we've been talking in the pre-interview about gold as real money. And, one of the things that I thought was interesting is the federal government is not supposed to be printing money. They're only allowed to coin it. So I just wanted to start you off with that. Go ahead and just give us the foundation for what money should be and what the federal government, should be allowed to do based on what is in the Constitution.
Yeah, it's really quite clear. It's in Article 1, Section 8 and 10. And if there's any doubt as to what Article 1, Section 8 and 10 mean, it's quite clear in the Coinage Act of 1792, which is one of the first acts of the new Congress after the approval of the Constitution, as to what the federal government's monetary responsibilities and obligations are. And first of all, it's not an exclusive obligation. They're not the only ones to coin money in this country. And actually, at the time of just after the Constitution, there are many private mints coining money as well. But Article 1, Section 8 and 10, it says, first of all, that the federal government has the power to coin money. It doesn't have the power to print money. And secondly, it says regulate the value thereof. Now, that term regulate the value thereof is misinterpreted today. What the framers of the Constitution meant is that when you have a bimetallic system of gold and silver, you can regulate the gold-silver ratio so that there's always sufficient coinage in the country based on whichever standard you use. Now, the original standard for the dollar was a silver standard. And that remained in place until the mid-1830s when Congress adjusted the ratio slightly. And then in 1900, the Congress changed completely, going from a silver standard to a gold standard. And then the 20th century, of course, was a train wreck as far as government powers, government monetary involvement. Everything changed, particularly with Franklin Roosevelt's confiscation of gold in 1933. But, it's quite clear there for everybody to see, what the framers of the Constitution meant. And it was a system that worked, quite well. There were booms and busts, but they were relatively mild. And those booms and busts weren't a result of using gold or silver as the monetary system. Those booms and busts were a result of the banking system and operating a fractional reserve system where they didn't have enough gold or silver in reserve relative to the liabilities that the banks had incurred by issuing paper currency instead of actual real metal. So, we have a blueprint there that we can go back to a sound monetary system. And the interesting thing, Ken, is that after the war between the states in 1869, Congress, and this is when they issued the greenbacks, the infamous paper currency called the greenback.
Right.
Congress realized that the monetary system had gone astray, and they needed to get back to a sound monetary system. And what they did is they created a 10-year plan called the Redemption Act. And 10 years later, after planning for it and taking the steps necessary to resume a constitutional monetary system, it was put into place. So, I mean, if we had the leadership and the will to go back to a sound monetary system, and what the framers of the Constitution had intended, we could do it very, very easily. And obviously, gold and silver still work as money. Gold preserves purchasing power over long periods of time. We just don't use it as currency anymore. But it's interesting, too, in that respect, because things might be changing in Texas, where you are at the moment. Texas passed last September what's called the Texas Depository Act. And what they intend to do is the state of Texas will operate a vault where gold and silver will be stored, and that gold and silver can be used as currency. But the interesting thing is that the law allows gold and silver to circulate electronically online, while the gold and silver stays in the vault, which is basically what we do in gold money. So it'll be interesting to see how the state moves forward with the implementation of that act, which was signed into law by the governor of Texas last September.
James, I just had a conversation actually with Harry Dent, a popular contrarian. He doesn't believe gold is money. He calls it a commodity. I haven't released the interview yet, but we were having a conversation about it. And one of the things he brings up is that it's a commodity, and you mine it, and there's volatility in the simple fact that there's not enough of it. It can't grow with the growing economy, the population. And I just want to kind of get your thoughts on why gold is sound money and not just a commodity.
Yeah, first of all, in my mind, it is a tangible asset, but I don't call it a commodity for a very purposeful reason. Commodities are mined, consumed, and disappear. Even copper, it disappears when it's dispersed in millions of applications around the globe. But gold is mined and accumulated. It doesn't get consumed. It doesn't disappear. All of the gold that's been mined throughout history still exists in this above-ground stock. It's about 170,000 metric tons. Now, this above-ground stock is the money stock. It's what I call gold's M3. You talk about M1, M2, M3 for the dollar. This above-ground stock of gold is gold's M3. And the interesting thing is that this above-ground stock of gold grows by about 1.75% per annum, year after year, which is approximately equal to global population growth. So over long periods of time, the money stock grows, the world population grows, and you have this consistent supply-demand between the number of people and the supply of the money stock of gold. So gold preserves purchasing power over long periods of time. An ounce of gold today buys the same amount of crude oil it did 60 years ago. The story is that an ounce of gold today can buy a man's suit. An ounce of gold could have bought a Roman senator his toga 2,000 years ago. So, gold is money. It's not a commodity. It's something different. It's a unique kind of tangible asset. It's a tangible asset that's produced for accumulation, not for consumption. And it's produced for accumulation because its usefulness occurs because of its usefulness as money. In other words, it's very good in measuring prices, preserving purchasing power over long periods of time, and it's even useful as using as currency. But recently that was, in the 100 years ago, that was replaced mainly by paper currency and checks. But with technology today, gold can once again be used as a very efficient form of currency.
James, is it necessary for gold to continue to grow in supply, or for any currency to continue to grow to facilitate a functioning economy? You mentioned it growing at the same rate as population, but is that a meaningful... are they connected in the fact that gold needs to keep growing? I mean, Bitcoin, for example, has a limited number of coins that will ever be mined. Right now it's currently growing, but eventually it's not going to grow. And is it a problem in an economy for the currency to stop growing and for it to just continue to become, more, to be able to purchase more and more stuff and appreciate over time rather than depreciate?
Yeah, it's a good question. In theory, no, it doesn't have to continue to grow, but it's a very convenient factor that it does grow consistent with population growth because it keeps supply and demand in relative balance. And it's not only the supply and demand of gold, the world population growth and the above ground stock, but new wealth creation year after year is also approximately 1.75% per annum to 2% per annum. So you have this consistency in gold. But if the gold stock were to stop growing, gold would just become more valuable. Prices would adjust. And see, this is another thing about, going back to the comment I was making about regulate the value thereof. Governments really can't regulate anything effectively. The market itself is the regulator. And it was a flaw, in my view, that you had a bimetallic system, because when you regulate the gold-silver ratio, which is what Congress had been doing, up until 1900, was that you were price fixing. You're fixing the price of gold relative to the price of silver. And it's impossible for regulators to determine what the exact price is. The market is the best way to determine what the price is. So, but the problem is that if gold were to stop growing, it makes economic calculation a little bit more difficult in terms of providing that consistency of purchasing power. In other words, instead of an ounce of gold buying the same amount of crude oil today that it did 60 years ago, an ounce of gold would buy over time more crude oil if the supply of gold stopped growing, because gold would become more valuable relative to goods and services.
Mm-hmm. Sir, when it comes to the shortage in gold, or actually in silver, when people go to their local bullion dealers, we know that they can still buy pretty much for spot. And I know this is kind of a hard thing for people to wrap their minds around, this shortage that everyone's talking about. What I've tried to explain to people is what you're able to buy at your bullion dealer is just window dressing for the shortage that would go on in a real crisis. But I'd love for you to be able to explain this to the audience the way you know how.
Yeah. There's a question of buying $10,000 worth of coins or $10 million worth of gold and silver. It's the larger purchases are very difficult to do these days because metal is tight. That's the way it's described. It's hard to come by. It's very easy to sell metal into the market because the demand for it is very high, particularly at these low prices, but it's very hard to buy it in large quantities. And the way you see this is in terms of the premium that you pay when you're purchasing the metal, or the relative to the spot price. Gold should, I don't want to get too technical here, but the future price of gold should always be higher than the spot price of gold. And this is just a function of mathematics. The money with the lowest interest rate is always you always see it trading in contango relative to monies or currencies with higher interest rates. But occasionally gold will go into backwardation, which means that the spot price of gold in dollar terms is higher than the future price of gold in dollar terms. It's an aberration, but we've basically been in a backwardation since 2013. And it's been at worse at times and less worse at times. It's been fluctuating, but it's been basically in backwardation. And what that's essentially suggesting is that it's very difficult to get metal. Sometimes even you see it in the retail level. If, for example, silver were, to use an example, $20, I've seen examples, if you're buying coins, you might have to pay $24 or $25 to buy a coin simply because there wasn't stock available. That's what backwardation basically is, that difference that you're paying over and above the spot price in order to get physical metal in hand, as opposed to the paper alternative, paper gold or paper silver, which are not real gold or real silver. They're just a promise to deliver gold or silver at some future date.
And really, when the big money starts demanding deliveries, that's when we'll see the big problems. It's not the guy like me who buys, a few hundred ounces at a time of silver or a few ounces of gold at a time. It's the big money. When they come and they start demanding, that's where we could see the big problems come in. And have we seen that yet? Have we seen any indication that the big money is coming in and wanting precious metals?
Yes and no. You're seeing institutions moving toward gold. Even insurance companies now are looking at gold because of negative interest rates. Viewing gold as an alternative to hold liquidity, because even if you have a small storage charge, the storage charge for that gold is less than the negative interest rate if they had money on deposit in some bank in today's crazy world with negative interest rates. There will be a tidal wave eventually, but here's the interesting thing about that, Ken. We had a crisis in 2008, but that was a liquidity crisis. It wasn't a fear crisis. Even though gold did well out of it, it wasn't driven by people being fearful for their money. It was being driven by people seeking liquidity to cover any debt obligations they had, or to keep their head above water. To go back to a real fear crisis, you have to go back to 1932, 1933, which is basically out of everybody's living memory. When you have a crisis like this, a true banking crisis, people move out of paper into physical because they want to avoid counterparty risk. They want to, instead of holding a paper promise, they want to hold a tangible asset. So you move down the spectrum. You move from, maybe a time deposit to a checking account deposit. Eventually, you pull money out of the banks, and you used to be able to go into gold certificates, but even a gold certificate is paper rather than gold. So you redeem your gold certificate for actual physical metal, and that's what was happening in 1932 and 1933, and that's what I think are going to face the next big crisis that's coming. It's going to start out like 2008, where people are going to be thinking about, okay, what about liquidity? But it's going to end up like 1932 or 1933, where in the final analysis, you get out of the currency completely and get into tangible assets, particularly gold and silver, because only a tangible asset does not have counterparty risk. In other words, it's not dependent on someone's promise to pay.
James, one of the things you've talked about is the sham of ETF gold ownership and the fallacy of the 580 metric tons allegedly added to gold's ETFs in 2016. And I'd love for you to be able to share some of your thoughts on this show.
Yeah, I guess when you're buying gold, the first question you have to ask yourself is, why am I buying this? Am I buying it because I'm a professional trader and I want to profit from fluctuations in the gold price by either buying it in anticipation of higher prices or selling it short in anticipation of lower prices? Or am I buying gold because I want to have money that's outside the banking system? I want to have money, liquidity, without any kind of counterparty risk. Well, most people, when they buy gold, they're buying it for that second reason. They want the safe haven aspects of gold. When you're buying an ETF, you're not buying gold. You're buying shares in a fund, the purpose of which is not to back those shares with gold. If you read the prospectus, the purpose of that fund is to track the gold price, and they have a variety of different ways of doing it, including owning some physical metal. But there's so many loopholes in that prospectus, you don't really know whether the gold is fully there or not fully there. So the way I see this is, if you're looking for the safe haven aspects of gold, the attributes that it's sound money, that it's money outside the banking system, you have to buy physical gold. Leave the ETFs, the futures, the options, etc. For the professional traders, stay away from them. Go for the physical metal. And when you go for the physical metal, there are only two ways to do that. You buy it and you store it yourself, or you buy it and you have someone store it for you, which is what we do in Gold Money. And if you do that second option, just be sure that you have the assurances of integrity from that company that you're working with, that your gold and silver are safe and secure, because these are the bedrock assets of your portfolio, and you don't want to take risks with them. So you want to make sure that they follow the procedures like we follow in gold money, that the gold is insured, it's in a vault where you choose in different countries around the world, that the gold is audited, et cetera, et cetera. It has to have, good governance procedures so that you know that your gold and silver are safe.
Mm-hmm. Well, James, I really appreciate you taking the time to come on the show and kind of talk to me about money, gold as money, gold is real money. There's, lots of debates out there regarding, whether or not it's just a commodity. It should be, we should go back to something that represents, a sound money system. And I appreciate you coming on. So if you'd like to share some, additional words of wisdom with the audience as we say goodbye here and just tell everyone a little more about gold money, feel free to do so.
Yeah, I appreciate the opportunity to speak with you, Ken. And in your comments here, you're just bringing up one thing that I would like to make. Whether gold is this or gold is that, we're in, and this is why John and I called our book The Money Bubble. We're in a bubble. People have lost sight as to what money really is. What we call today as money is not really money in the true historical, accounting, and legal sense. It's really a money substitute circulating in place of money. Dollars are a money substitute. They're not money themselves. And this is the key point of the book. So when you're in a money bubble, you have to sort of step back and think through, what you're actually doing here. In the internet bubble, back in 2000, people were saying profits don't matter, only market share does. When that bubble burst, everybody realized that what a silly thing to say. The real estate bubble, housing prices only go up, they never go down. After that bubble burst, everybody realized what a silly thing to say that housing prices only go up. Well, the money bubble, it's a similar type of thing that everybody says, well, the dollar is money, but it's really not. It's only a money substitute circulating in place of money. And as this money bubble bursts, people are going to go back and truly understand that what gold really is, and that its usefulness comes from the fact that it's accumulated and useful in economic calculation, preserving purchasing power over long periods of time, et cetera, that it really is money. Anyway, great speaking with you. If people want to learn more about gold money, go to goldmoney.com. And there's a lot of information there, including research on a lot of these different ideas about gold's role today in the modern economy.
Well, thanks, James. I really appreciate it. You're a thought leader, and you've given us a lot of meat to chew on here during this interview. So I hope to meet you soon, and actually, hopefully, we'll be able to chat in another interview down the line in a few months or so.
Yeah, I'd be happy to do that, Ken, anytime.